With equity crowdfunding, you're investing in a company, you're buying equity and you're getting shares. So you have some of the potential benefit and upside of being an owner of the business. Having a portfolio approach, so investing in multiple companies, not investing in a few. And again, if you invest in 50 of these companies, the probability of you getting a 25% IRR, so a 25% return year on year, is much higher, and it sort of goes exponentially. All of my investments are in Equitise companies. And indeed, a lot of my personal wealth and the last 10 years of my time and energy is tied up in my equity in Equitise. I have something like 40 or 50 companies I've invested into Equitise.
Hi everyone, welcome to the Upworth Talks, the podcast for the modern empowered individuals, where we sit with inspiring characters and leaders in their field to deep dive into the world of personal finance and money management in Australia and beyond. I am Maxime Shori, co-founder of Upworth, and really super happy to welcome you today in the first Upworth Talk. I have been managing startups across APAC for the last 5 years, and I am passionate about personal finance and innovation. I will be sharing my passion with you in all these podcast series, along with my co-founder, Alex. As it is our first talk, happy to share a few words about what we are doing at Upworth. We are trying to build the future of money management from Australia, empowering everyone to achieve financial independence. With Upworth, you will be able to seamlessly see your entire wealth at once, whether it's bank accounts, stocks, cryptocurrencies, retirement plans, property, mortgage, you name it. Secondly, plan your journey to financial independence. And thirdly, grow your wealth. However, an important reminder, guys, this talk discussion with Jonny is not investment or financial advice. It is for informational and entertainment purposes only. The opinions expressed are strictly personal and should not be relied upon for investment purposes. As always, seek professional advice to review your personal circumstances and objectives. That said, we have the honor to receive today Jonny Wilkinson, co-founder and managing director of Equitise. Jonny is an innovator and a pioneer, founder of the first crowdfunding platform in Australia and a key player in the democratization of private investment in ANZ. He has made it possible for you and many others to invest directly in promising companies that are not listed on any public stock exchange. Jonny, thanks for staying at the top of your pioneering spirit by joining us as the first guest speaker of the Upworth Talks.
Thank you. Thanks for having me.
Thanks again, Jonny. Super happy to have you here for the first talk. Maybe we can start, with I'm sure our auditors want to know a little more about you, and maybe can you share with us a little about your background and career? What have been the highlights of your life and career so far?
Sure. So my background, I studied economic and finance in Sydney. I'd always had an interest for business. While I was at university, I worked for Red Bull. It was pretty exciting. Learned a lot there and got some great experiences and some insight into brand and marketing. And then when I was finishing university, I did a summer internship at Citibank. And then this was around the GFC, so things weren't looking great. I was going to take a year off and go travel and relax and do nothing.
So GFC, you mean global financial crisis, right?
Yes,
okay.
Sorry, the global financial crisis. So I was planning on taking some time out before going and working full time. But given the climate and everything, the advice I got from a number of people was, who knows what's going to happen in 12 months' time? Why don't you start working now? And there was a job. I started working at Citibank in equity markets. I was at Citi for a bit over 5 years, institutional stockbroking side of things, which was a great insight into how equity capital markets and equity markets work, before then deciding to branch out and start Equitise.
Really cool. Maybe can you tell us more a little about this kind of transition, right, from working in a big bank in Australia to launching your own business and in this space? How did you get the idea? What motivated you initially? How was this transition?
Sure. So not far from here, a few hundred meters away, me and my co-founder Chris were at a friend's birthday dinner. We were each kind of getting itchy feet or wanting to look for the next thing and start, start a business or get out of our corporate jobs. We each knew around the global landscape for equity crowdfunding and private investments and venture capital and angel investing. So a friend of ours who was early at AngelList, a guy, Ash Fontana, we'd been watching him and what was happening with AngelList in the US, and they were pioneers in that space. And then in the UK, Crowdcube and Seedrs were the two dominant and early platforms in the equity crowdfunding space. So we were watching what they were doing. Chris and I got chatting and we're like, let's put together a deck and a model and, go pitch for some money and see what we can do. Woke up the next day with a bit of a sore head, didn't know what was going to come of it. But literally the next day on my Iris, which is a news feed around financial data, something came up saying AWI Ventures looking to make some early stage investments in fintech. So I copied it, sent it to Chris and said, this is fate, let's do it. So
at the time you could not crowdfund for Equitise, right? It was not allowed in Australia.
No, the laws in Australia hadn't changed. So equity crowdfunding is an evolution of both principles of crowdfunding and also where global Western capital markets have gotten to with access to information and investors investing in unlisted companies. So no, at the time we couldn't. The only options we had were to bootstrap it or get some investment or go through an accelerator program or do something to kick it all off. And because it's a fintech business, obviously there was a fair bit of time and capital and things required to get it going. So we went through this accelerator program. So it was originally called AWI Ventures, then became H2 Accelerator. And it has helped birth a lot of the current sort of companies in Australia that are doing quite well in the fintech space. Some companies like Spriggy, StockSpot, some other businesses like that have come after and have been pretty innovative and pioneering in the Aussie fintech landscape.
Super cool. No, that's a great story. So you managed to get into the accelerator and get some initial funding. So maybe like when was that again?
That was in 2014.
2014. Okay. Maybe you can so I think you explained a little the crowdfunding, right, and especially the area in which you are, which is equity crowdfunding, so allowing private investment for equities in unlisted company. So maybe like in the US, as you're mentioning, or the UK, right? I think in the 2000s it began to develop quite a lot. But in Australia in 2014. It was still, not regulatorily available for investors. So, can you tell us a little more about, the story of, how to basically create this market in Australia? And I think you also, ventured into New Zealand. So maybe you can tell us a little more about the early days of Equitise.
Sure. So in Australia in 2014, there weren't any laws or regulations that allowed for equity crowdfunding. In the UK, they had sort of amended some existing regulations to allow people to do it. In the US, the laws had been passed but were continuing to kind of evolve to allow for it to work properly and wasn't properly functioning at that point in time. When we started, the then government was reviewing the legislation and intending to make some amendments, and at that point in time it was kind of just a mix of everything globally and then trying to apply it in Australia, and it was bit of a Frankenstein's monster kind of, and at that point when we quit our jobs and went into the accelerator program, it was imminent and there was an expectation the laws were going to change relatively quickly. So we thought, great, here's the time, here's the opportunity, let's do it. Unfortunately, there was a sudden change of government, which then meant the laws were basically put on the back burner. Good in some regards because the structure and the regulations and laws that were supposedly going to be passed probably weren't as conducive to what we needed for equity crowdfunding to be a success. But it did mean that it was going to be a year or two before we could even kind of get some laws through to allow us to do what we wanted to do and run the business as intended. Fortunately, New Zealand had changed their laws in 2013 and had done a once-in-a-generation securities law rewrite, and a part of that they included equity crowdfunding. So got on a plane, went to New Zealand. Everyone was quite welcoming. The regulator, angels, accountants, lawyers, people in the startup ecosystem were quite willing and happy for us to go there and get going. So came back to Australia. We had a board meeting. I drew the short straw, and I moved to New Zealand the next day for 18 months. So we got the business set up and licensed out of New Zealand and began operating there. And then after 18 months of operating and hiring a couple of people to run things in New Zealand, I came back and we lobbied the government to change the laws in Australia.
Okay, so like the Equitise is still operating in New Zealand as well?
Yep.
Yeah,
So
okay.
we've been there since the beginning of, been licensed since the beginning of 2015. And we still operate there. The market's obviously a bit more established and has gone through almost a full cycle. Last few years it had sort of tapered off a little bit, but again, it's picking up again now. And we've got some really exciting New Zealand deals coming through in the next 6 months, actually.
Super cool. And so, yeah, you came back in Australia, and so it was still not there. And so you actually took part in lobbying or helping the government in setting up the regulation for Australia on equity crowdfunding, right?
Yes. So 2015, 2016, the new government was reviewing it and talking about making some changes. The opposition, the Labor government, were broadly supportive and willing to, entertain or have equity crowdfunding come through, but they wanted certain protections or provisions and parts of the regulations to provide certain protections or limit things or make it a little bit, in their view, a little bit better for the market. So that meant that Labor, who had enough numbers that the Liberal government couldn't push through the legislation, meant they needed their support or to get support of all the independents to try and get the legislation passed, which meant we had to work with the government and then also work with the opposition to try and get people to come together and find a middle ground and an agreement around what the laws should be and how the regulation should operate and what the market should look like. So we had to roll up our sleeves and get involved with that.
And so in 2018, right, that's when the law passed?
So, yeah, the law passed in 2017, the first part. It became effective on, can't remember the exact date, but on the 11th of January 2018 was when we launched the very first deal, and we got our license on that day and launched on the same day. We'd been waiting.
Pretty efficient.
Yeah. We'd also been told or given the indication a few weeks before that we were going to get the license and it was going to be in January sometime. So we were ready to go, and we'd been operating for a couple of years in New Zealand already. So yeah, we launched beginning of 2018. There was an initial regulatory regime, or the laws allowed for unlisted public companies to use the equity crowdfunding regulations to raise money. Towards the end of 2018, an addition allowed everyday unlisted companies, so proprietary companies, the Pty Ltd, which is the most common form of company in Australia, it allowed those companies to then use equity crowdfunding to raise capital.
Super cool, super cool. So even though I'm sure we don't want to focus too much on all the details of the legalities, but maybe in a few words, what are the main characteristics of the regulatory frameworks and protections for investors, private investors in equity crowdfunding in Australia?
Yep. So in simple terms, a company that's not listed on the stock exchange can raise up to $5 million every 12 months from everyday investors. So retail investors is a term for anyone who's...
You and me, basically.
Everyday investors. So if you're not wholesale or sophisticated, which means you're not a professional in finance or quite wealthy, then you're an everyday retail investor. So retail investors can invest in these companies. They can invest up to $10,000 into each company every 12 months. The companies need to go through a process with a licensed platform like Equitise. It involves putting together an offer document which has information about the company and the offer and all of the terms, and then they can make an offer and these people can invest often from as little as $250, normally where we sort of set the minimum for an investment, and they're becoming equity holders, so they own ordinary shares in these companies.
Super clear, super clear. And so, no, I think that's basically opening the landscape to most, all basically Australian adults, I guess. And so maybe can you tell us a little more about, what are the key differences and advantages to start with of crowdfunding from a personal investment perspective? I would say about, both, and also the general and maybe specific risk related to this asset class.
Sure. So venture capital, private equity, or unlisted equity as a asset class tends to be obviously a little bit riskier than listed equities. It's all relative and can depend on the size and how established the company might be and how profitable it could be too. Forgetting that there's obviously not quite the same reporting obligations that a company has compared to a company listed on the ASX. So the access and information provided isn't as in-depth and rigorous, which is some ways is probably better and appropriate for some of these earlier stage companies because the governance and cost and requirements to have a lot of disclosure and company secretary and all the sort of things going along with it and being audited, is quite expensive and can often be a distraction from these companies. So I think, equity crowdfunding in principle is the evolution of kind of Western securities laws and where there's a lot of access to information these days. And again, companies can put forward an offer in a particular way and provide information and access to everyday investors to make a discerning assessment and decision around investing in these sorts of things. So typically alternative assets, which this falls part of, is an area that, most portfolios, and particularly portfolios of your sort of everyday investor who doesn't have a lot of wealth, it's normally quite a small part of the portfolio. It's normally in the single digit percentage of a portfolio, and that can depend, again, the makeup and mix of the different alternative assets. But investing in these sorts of things can be quite beneficial, and on the opposite end of the spectrum, you have wealthy endowment funds or US college, those sorts of organizations that have lots of capital and lots of time will often skew their mix of assets towards these alternatives and private equity and venture capital, and may even have 40, 50, 60% of their portfolio in some of these alternative assets. The benefit of investing in some of these sorts of assets is they tend to be not in line or they're not as cyclical as your listed stocks. They tend to be a different sort of exposure to the economy, and these companies might sort of have returns or different growth profiles based on where they are and the stage of growth and how established they are. So there are some benefits around investing in this as a different asset class compared to your stocks and bonds and traditional investments. And it just depends on who you are and kind of your horizon and your risk appetite as to how appropriate it might be.
No, super interesting. And indeed, higher risk and potentially linked with higher rewards as well, as you mentioned. And not as cyclical as well. That's interesting. And so, speaking of rewards, I guess, what's the usually like the timeline, let's say, for the returns or the gains, and maybe you can let us know and let our the potential investors around know about from a tax perspective, like what are the basics of gains from this asset category.
Sure. So typically it's a more medium to long term horizon. It is much like venture capital, and if you look at your average venture capital fund, it tends to have a 10-year horizon, which gives the fund manager time to invest and then see the companies through to an exit. Medium to long-term horizon is kind of what you should generally expect in these types of investments, particularly if you're investing in the earlier stage, so the kind of seed Series A. It will depend. We have some companies that are a little bit later on. They might be close to a listing, or they might be a bit more established. They might be sort of at their Series A, Series B. So the potential time to exit might be a little bit shorter. It just depends, and we try and, where possible, make that as clear as we can in the information and articulate the potential opportunities the company will have in returning value to shareholders. So typically in this area, you're looking for a capital gain, and that is often from the company you invest in being acquired, and your shares going from $1 to $2, $10, whatever it might be. Or they might list on a stock exchange, which then gives you an ability to readily sell the shares. Always depends on how liquid the stock exchange might be for that particular company, but you do have the ability to then sell your shares in an open market, which is a little bit more accessible. There are potential ways to sell before then, but there's no sort of guarantee, and there's no necessarily easy way of finding a buyer and going through that process. And particularly private companies may have provisions that make it a little bit harder, or you have to go through a preemptive process or go back to the company to be able to sell the shares.
Okay, understood. And so so basically will be subject in case of gain to the capital gain tax in Australia.
So it would typically be a capital gain. It depends with some of these early stage companies. There is a tax treatment that is available for early stage innovation companies, ESIC. So companies that are early and haven't sort of gone beyond a certain turnover, if they are doing something innovative and if they hit some other objective tests, then they can be an early stage innovation company. And when you invest, as an investor, you actually get an offset up front. So a portion of your investment can reduce your tax, and then any investment and capital gain from years 1 to 10 are capital gains exempt. Outside of that, typically investing in these sorts of assets, you will have some form of capital gain, and that depends on your tax situation, or if you're investing through your super fund or a trust or a company or directly, and what your tax rate is.
Super clear, and interesting, and indeed that's something to look at when you invest in equity crowdfunding to check the status of the company and if they are part of the ESIC category. Okay, so I mean, like, we just looked at the upside in a sense, right? And so obviously there is also a downside, a risk, and so what are the kind of, I mean, there is a risk, of course, linked with the future performance of the company, but there are other types of risk as well, and I'm sure as part of the regulation, also as part of your job at Equitise, is to give a certain number of guarantees to investors in terms of certain requirements that companies have to meet in order to be, for instance, listed and available for investors on Equitise. So maybe can you tell us a little about how you work to make these opportunities meeting a certain number of criteria to make sure that they are, I mean, as safe as possible to invest for the investors.
Yeah. So with the regulations and to make an offer under the equity crowdfunding regime, excuse me, company needs to present certain information in the form of an offer document. They also provide us with other information, or we collect or ask them to provide information for us to do our own sort of internal due diligence, as well as what we're required to do under the regulations. So there's things like the company and the directors of the company, major shareholders. So we do checks around those, and good fame and character. We do certain checks around bankruptcy of individuals involved, or if the company has been through prior liquidation, or things like that. So we go through a process. What the company needs to do to make the offer is actually put together an offer document, which has a lot of information. We, as the platform, have requirements under our license to do checks around that information, as well as I said, around sort of some of the people and the ownership of the business. So there's things we do. There's also things we have internally that we do that we don't necessarily publicly state or provide. But for us to be comfortable in helping a company raise, we go through our own internal process as well.
Cool, and it will be like companies that are, obviously legally operating in Australia with all all the compliance that is being checked as well, the incorporation, and as well sharing some financial statements.
Exactly. So a company needs to provide financial statements, which we check, and there is other information that they provide us with and things that we check with ASIC to make sure that the company is appropriately registered, that the shares on issue are updated and reflect what's in the offer and all those sorts of things, so that people kind of know that the basic terms and what's being presented and the information is accurate.
Okay, so perfect. So you convinced me. Now I'm up for it. So let's say people want to obviously look at the opportunities in this space. And so speaking of that, like, are there specific types of projects? But offers, equity offers in your, for instance, in Equitise. Does this asset class, correspond to certain types of startups or early stage company that you've seen based on your experience over the last 5 years in Australia?
Sure. So I'll just clarify that point that you touched on. So typically with crowdfunding, or traditionally what people know to be crowdfunding, like Indiegogo or Kickstarter, it is a project and you're contributing some money. You might get a product or something back from the company, or you might be funding the first prototype. One of the classic examples of that was the Oculus Rift, where people paid, I can't remember the exact amount, call it $500 US to get one of the first runs of the Oculus Rift goggles. Not long after they raised that money through that project, they were acquired by Facebook for, I think it was 2 or 3 billion US. A lot of the people who contributed to get the goggles didn't get anything more than a pair of the goggles in 2 or 3 years' time. So with equity crowdfunding, you're investing in a company, you're buying equity, and you're getting shares. So you have some of the potential benefit and upside of being an owner of the business. So what we do and the process we go through to allow that to happen basically has what the website and the offer is, the information around the offer, the terms of the offer, what you're buying, how much per share, all of those sorts of things. The way we have it set up on the platform is we try and make it as simple and easy to analyze and understand the information that we present, and even compare apples for apples. So a company might be a different sector or a different stage, but we try and make that apparent and provide the information that people know what they're doing. So the valuation of the company might be higher if it's more established, or if it's in a sector with a bigger market opportunity, or different things might impact the terms of the offer and even the value of the business. So what we do is we make some sort of analysis and work out how suitable we think a company is. And a big part of that and whether or not we think it's successful is who's going to invest. So you need a crowd of people that want to get behind the company. Some of the companies that do best are those that already have a strong group or crowd of people around them. So stakeholders, whether they be customers, friends, family, other people that know the business or in the networks of the founders of the business, they're the ones that do best. So some of the companies that have done really well are breweries, not just with us, but globally and historically with equity crowdfunding. Who doesn't like the idea of being an owner of their local craft brewery? You get a return by going down. You're already probably drinking there or buying their beer. They're quite common. Distilleries also. Some fintech businesses. Obviously, if a fintech is doing something that is changing the landscape or disrupting a traditional...
What we are trying to do at Upworth, we should speak later.
Yes, let's do it. So if people want to get behind that and want to potentially help support and fund that, and they see that as a viable opportunity, then that's another area that historically equity crowdfunding has done quite well. One of the standout raises that are referenced globally is Revolut, which maybe a lot of your listeners and customers might know about. They were one of the pioneers in fintech in the UK, and they've done several raises. It's a multi-billion dollar company now. They're not listed yet, but they've raised money multiple times through equity crowdfunding, and some of the investors have done really well out of it.
Super clear, super clear. So yeah, across different sectors, mostly like B2Cs and companies that are, able to, that already have, a crew of people that can be involved in these activities, in this offer, in this crowdfunding
For sure.
equity offer.
The easier it is to understand what the company does, or even put your hands on the product, or if you've used it, or if you understand the problem that they're solving, then naturally as humans, you'll have some sort of affinity or some connection to what they're trying to do. That's where you're more likely to want to be an investor and supporter of the business.
Super clear, super clear. And so, so you're basically, obviously there is the legal protection, then, Equitise, you guys do also all the process of review, and then, it becomes available on the platform, and then people can look at the information on the website. But like, what would be your, based on your experience, what are the most important things that an investor should look at when considering a crowdfunding offer?
Sure. So again, we try and present all the information so you can make an assessment as to the size and stage and where the company is at. So that is an important assessment. One of the things we talk about, and again, this is not advice, but looking at an investment and some of the literature around investing in more early stage seed Series A companies does definitely support having a portfolio approach. So investing in multiple companies, not investing in a few. And again, if you invest in 50 of these companies, the probability of you getting a 25% IRR, so a 25% return year on year, is much higher, and it sort of goes exponentially up as you add more companies in. So we like to encourage people to think about diversifying, not investing in one particular sector or at one particular stage, or concentrating their risk in a couple of companies. So we would say, if you've got $1,000 to invest, put it into a few companies, or even better, if you've got $10,000 to invest, put 1,000 into 10. Something more like that, so that you are trying to get a bit more of the benefit of diversification, and that's how you can potentially get greater probability of returns. And it kind of lines up with more of the traditional venture capital model, where they'll make a number of investments, and sort of one of the investments is likely to give them hopefully outsized returns more than 10 times and effectively pay back the entire fund, and a few others might generate some modest returns, and some of the rest might fail or might not deliver much in the way of returns. So definitely trying to understand the type of company, the risk and the stage they're at, and then always reverting to having a little bit of a lens of diversifying and within this asset class, trying to make sure that you're kind of spreading your bets.
Yeah, and even if it's relatively early stage, I guess certain numbers would be available there, right? Like in terms of evaluation of the, let's say, the market opportunity, the size of the market, the existing number of customers, or the existing like revenue generation. Maybe not profit at this stage for some of the early ones, but I guess like some idea on the path to profitability, and also seeing like the potential for growth within the market and of the market. Are there this is also something that will be able to be for most companies visible on your platform, on your listing for the offer, right?
Sure, we try and make this information available and accessible. There are some limitations with the regulations around companies providing too much in the way of actual forecasts. But if a company, for instance, is going after a $1 billion opportunity in a big market, and they can articulate what they intend to do and how they might take 10% of that market, or whatever it is, even if it's a multi-billion-dollar opportunity and they only want to take a couple percent and can still run a very profitable business, and think that one of their competitors or a more established player in the space might acquire them, then there are some of the things that people might look to, or some of the signals that people are looking at. The other thing with early stage companies, a lot of investors look for is obviously what they're doing and what sector they're in, but the founders and the people involved with the business. So founders who have some experience, passion, people around them helping them, those sorts of things, that can be something that's worth looking at, and part of your assessment is to making an investment. So, good founders might have an idea or a business, the market or the landscape might change, and they might need to adapt the business, or pivot is a term, it's a bit overused. But if they have the skills, the capabilities, and the temperament, they might be able to adapt the business and continue to succeed and grow and even have some success, hopefully. So it just depends, but there's a number of things to look at and try and make an assessment. The early stage of the company, the less true points of data or things that you can rely on, sometimes it might be a bit more of a gut feel, or, I know this space, or the problem they're going after, I think is a really big problem. I think the market opportunity is significant, or these look like quite smart people, and the way they're articulating the opportunity and even the way that they're going to operate the business might be highly profitable in a small niche within a market, or something that you look at and might know or understand, and based on that, might look at investing.
Yeah, no, I mean, definitely. And I think maybe we can go a little more, in details, or a few examples of companies that you currently have. Let's say, if our listeners want to check out your website, and like, what are the cool or a few current companies that are available on Equitise right now?
Cool. So I'm not sure when this is going to go to air, but right now we have a company called Invaluable. They are a business in the health and wellbeing space. They do subscription vitamins and supplements. So you go through a questionnaire and assessment, and they will say, here is what we suggest you use, and here's a regime of vitamins and supplements to take. They do it in a easy, packaged, daily, this is what you need to take every day, and send it out to you month by month. And there's an app, and there's other things that they do to make it really easy to try and obviously adhere to taking the vitamins and supplements. Also things that you can do to try and just generally track and manage your health and well-being. And they're doing some really interesting things in that space, and the future of the business is looking at doing more around providing better services, growing geographically. So they're in Australia and New Zealand. They've done really well. They're now expanding into Southeast Asia and doing quite well with that. Some of the initial signs are quite promising. And then as the future of kind of personalized health is evolving, they're doing some things around their app and other connected devices and your Apple Watch, and things that they can work with and incorporate to give you a much more tailored experience to manage your health and well-being as well. So that's one of the exciting ones we have.
No, interesting, and I think one of the other easy way to check the potential of the company as well as an investor is actually to go basically on their website or try out their product. I mean, for these B2C products, right, and see if as an investor we would also potentially be a customer, and we to appreciate their approach and their business model and brand, right? So definitely that's actually a good example of that. Thanks. So maybe, I mean, you already touched a little about that, right? But wanted to maybe discuss a little more on this part of the space for crowdfunding within the overall personal finance strategy. So you mentioned, usually the approach is to have 1-digit percentage of the entire portfolio that is allocated to this asset class. But there are any other, aspects to consider in your opinion, and based on maybe certain characteristics of the investor, maybe this rule can have some some different outcomes in terms of the degree of exposure to risk, or the appetite for a certain type of return that might impact as well the strategy across the allocations to this equity crowdfunding space.
Sure. So there's obviously a number of factors, and again, this is not advice, but depending on where you're at in your life, given how much capital or wealth you have to invest, given your ability to maybe weather some ups and downs or even potentially lose some capital, there are obviously big factors to factor in. Obviously, using myself as an example, I'm 36. I'm not going to retire for another 20 or 30 years, or who knows, maybe sooner. But what...
We can help you plan that with Upworth.
Yeah, hopefully. So you and your horizon and your willingness to basically take on risk and experience the ups and downs or the volatility associated with that are big factors to consider in how you invest and what you're investing in and that sort of thing. So as I said earlier on, you have these big sort of US colleges or endowment funds that have billions of dollars of capital and they have long horizons. They might not necessarily need the income, so they're not getting sort of dividends or bond coupons or money coming back to them each year in a consistent fashion that they're relying on, or there is a part of their portfolio that does generate that already. So if you're not necessarily looking for a bit more of a stable return and guarantee of income, then you can maybe look to kind of hit for the fences, and you can maybe look to invest in things that are maybe a little bit more risky and might have a bit of a longer time horizon. So with that in mind, investing in private equity, venture capital, equity crowdfunding, those sorts of things that tend to have a bit of a longer horizon, the risk is greater, but the potential returns is also greater. So factoring that in your portfolio and where you're investing, if you're willing to put some money in and leave it for 5 or 10 years and hope that maybe it doubles, quadruples, goes 10 times, 100 times even possibly, that's way of thinking about it. Same token, that could go to zero and you could lose your investment.
That's super clear. And actually, you are, Equitise is still quite young. So, and considering the time horizon we are looking at, right, you mentioned around 10 years. And then, so operating, in Australia since, in the last 5 years. So, but you've also been in New Zealand before as well. Are there any people that got their money back in a sense, or any interesting stories from Equitise either in Australia or New Zealand that you can share with us?
Sure. So the more interesting and most exciting one we can reference and names that people tend to know, company Car Next Door, who were doing a peer-to-peer car sharing, were acquired by Uber. And so we'd helped them raise some money a couple of times, and there were a number of investors that invested in that, and they did well. There's been a few other companies in New Zealand that we've helped that have listed. So a business that's in technology and trade finance and infrastructure that had listed and did quite well. Another business called Greenfern, who were a medicinal cannabis business listed in New Zealand. We'd raised some money for them. In Australia, there's a couple of companies we'd helped raise some money for that went on and have listed. One that some of your listeners might know about is Mad Paws. So we helped them before they listed. And so there's been a few, but we're waiting and expecting a few more to come through. And actually, as this has gone to air, we've got a couple of companies that are having some events or being acquired that we might be able to announce, hopefully, at some point.
Yeah. There is at the beginning, right? You have to wait and see, because obviously the time frame for this kind of investment, but it's really exciting. But actually, just curious, you mentioned some companies that listed in Australia or New Zealand. Obviously, I don't know to what extent details can be shown or not, and it's not about the details, but maybe can you give some examples more or less of returns that from some of those companies, in broad terms? Is it 20, as you say, 25% or 2x? Or just curious, what are the kind of ranges from the success stories? Obviously, the failures, it's easy, it goes to zero, right? But yeah.
So the one that was acquired, I can't really divulge that. So it's quite confidential, but one of the companies that listed in New Zealand, we raised capital for them 2 or 3 times before they listed. When they listed, the share price then performed very well, and we had a number of investors sort of hold and sell at sort of decent returns. So some of them, depending on when they invested, generated some, I think, about a 50% return in 18 months' time, and through as much to 4 or 5 times in sort of maybe a 3 to 4 year horizon, from when we first raised and when they listed. And then when it did list, it performed quite well. And I think if someone had have bought in the first round and timed it perfectly, they would have made more than 10 times their money. But as is the case with listed companies, the share price has kind of come off a little bit. And so if they're still holding, they're probably doing okay, but not quite the same as sort of 10 times their original investment.
Oh, okay, super interesting. So I mean, that's already pretty impressive, right? Even though we didn't, it's definitely less than 10 years, but you already have some quite exciting returns of some of the companies. And actually, like more or less up to now, can you give us just a few like key numbers about Equitise, like in terms of how many companies have raised through you and many like the amounts that have been raised and these kind of things?
Sure. So we've now raised, I think we've done something in the order of 150 rounds for about 120, 130 companies. We've raised in the order of 90 million. And yeah, we're sort of getting some good results. That's growing. And year on year, we're raising more and more money. And our investor client base is growing as well. People are becoming more exposed and people learning about equity crowdfunding and getting involved. And again, it costs nothing to invest, and it's a good, easy way to kind of dip your toe in the water and start investing in this sort of asset class. So we're getting more and more uptake and more investors all the time. So the market is growing and quite exciting.
Super cool. So you mentioned a very important point here. So from the investor perspective, there is no cost to basically invest. They want to invest 250 or 1,000 in a company. They will pay that money, and that's exactly the equivalent in share they will get, right?
Exactly. So just use $1 a share as an example. If you invest $250, your $250 becomes 250 shares.
Okay, and so your business model in Equitise is basically to monetize from the company side that are listing on Equitise. Can you just give us a few words on that?
So yeah, we charge a fee to the company for helping them raise the capital. Normally there's a little bit of money up front to help them put together the offer and us helping advise them around that process. And then there's a percentage of the capital that we raise for them we'll take as a commission. Super clear.
I mean, that's a great news for investors. I'm actually looking at a few of the companies on Equitise. Hopefully we'll make my first soon. Okay. I think so. Yeah. One question. So we have seen, right, the evolution, the crazy evolution of the maturation of the equity crowdfunding market in the world and more specifically in Australia. And what is your view on the future, right? I mean, are you expecting any transformations or changes in the equity crowdfunding space in Australia and beyond in the world? Do we begin to see certain trends that you think will be visible in Australia in the years and months and years to come?
Sure. So globally, and one of the reasons we started the business is an evolution of early stage capital markets and private companies staying private for longer or not needing to list. That began in the early 2000s and particularly sort of through the mid 2000s around the GFC. So with more capital and more willingness to invest in some of these companies, they're not necessarily having to list on a stock exchange as readily or quickly as they used to. So that provides a bit more of an opportunity. And alongside of that, and as there has been more money to invest in the space, the markets have evolved and become more established. And the infrastructure and the ability to invest and track your investments and have access to information around that has, again, become much more significant. So private capital markets are evolving. They have evolved. Australia and Asia is kind of following the lead of the US and UK and Europe. We're a little bit behind, but I think there will continue to be tremendous growth, particularly in Australia. If you look at where all the money effectively comes from, which is superannuation, the allocation to domestic venture capital and private equity has been quite low over time. That is increasing and continuing to increase every day. So private capital markets are evolving. There's more money and there's more investment in this area as an asset class. So we think that presents a great opportunity. We aren't saying we're kind of replacing or disrupting. The way we like to talk about it is we're disintermediating. So we're providing access for everyday investors, and we're trying to make it more efficient so that people can invest in these types of unlisted companies. So we think there's going to be more and more growth. And if you look at the ASX, which historically has been a very effective market for early stage listings, and the listing requirements have been quite low relative to some of the NYSE or Nasdaq or some of the European markets. You could list quite early in Australia, and you could be a $20 million company and raise a few $1 million and list on the ASX. As a market that had a lot of early stage mineral exploration businesses, and to this day, obviously, BHP and Rio are still some of the biggest companies on the ASX. It's been effective and not bad when you think about it in that sort of context, that they can raise some money, go get a mining lease, drill, try and find some gold or some minerals, and then continue to raise money and potentially find valuable resources that they can mine and sell and that sort of thing. But again, that's quite a risky sort of process and way of funding businesses. Again, because there hasn't been an established venture capital or private equity market in Australia, there have been a number of companies that have looked to list probably earlier than they really should have. That, again, is continuing to kind of change and evolve, and companies aren't being forced to list quite as early, and we think that's fantastic. And I think even if you ask the ASX, they've changed some of their listing requirements, and they want companies to list when they're more established and a little bit further down the line. So with the evolution and continual involvement of early stage capital markets and companies staying private for longer, equity crowdfunding, as well as other ways for companies to fund themselves and investors to get access and exposure, is the future of where we think money's going, and people and their investment and their portfolio. So equity crowdfunding in Australia is going to continue to grow and grow and grow and grow more and more, and has been growing very, very strong in the US and the UK over the last 5 to 10 years.
No, it's super interesting. I mean, like, do we have a few like numbers on that, like in terms of absolute and relative number, meaning like, what is like the kind of market size of these in Australia, and also relative in terms of like maybe more or less percentage over the total equity market, both from a general perspective and from a retail investment perspective, and also about growth in these two categories. So what you're saying is that the private equity basically section of the overall equity market has been growing faster than the public equity part, and that applies both for the general market and for retail investors. Do you have any more info on that?
Not at hand.
Okay. I mean, more or less, if
you had to let me know, I could have brought some. But generally speaking, private equity and unlisted assets have been growing, particularly in the last 6, 12, 18 months. IPOs and new issuance on public markets has declined and dried up. Last year, equity crowdfunding actually, if you remove some outliers, raised more than IPOs on the ASX. And there is a growing opportunity for obviously private capital and private markets to keep up and challenge some listed markets. Again, it's the evolution of early stage capital markets and these companies staying private longer. Obviously, you tend to get a large number of ginormous businesses, to use a technical term. You get some really, really large listed companies.
Giant enormous.
Yeah,
Okay.
that obviously weigh things towards the total market cap of listed companies. But actually, when you look at all of the value of unlisted companies and what's happening off the ASX or in private markets, there is a huge amount of money in it, and that as a percentage is continuing to grow. And as a subset of that, obviously equity crowdfunding is growing and going to continue to grow in the next year, 2 years, 10 years, 20 years.
Cool. No, I think that's super clear. So both for investors and for companies that would like to explore this equity crowdfunding with Equitise, so basically they go on your website like equitise.com.au, and then they can basically like look at all these there, right?
Yep. So it's just equitise.com. We have all the companies. Again, costs nothing for an investor to create an account. Costs nothing to invest. The information is presented. It's all online. It's all electronic. So if you want to invest in a company, you just create an account, do electronic ID verification, like the old 100-point ID test. You do the payment online. You get record of your investment, and once the deal settles, you'll get either a share certificate or some statement or access to a digital share registry. So very easy, very quick and simple. So you can get on, look at the opportunities. Often, if a deal is not ready for investment, we might have it in an expression of interest phase. So until it's ready, people can get online and then put their name down and express interest, and we'll notify them as the company is preparing and getting ready to launch their offer. From a company, obviously the markets have been a bit subdued lately, but there is more and more interest and demand. So companies looking to raise, they can reach out to us online. There's a form or questionnaire that they can put their information into. Our deal team will look at that and make an assessment and work out if we have some questions or if we think the business might not be suitable. Try and interact and engage with the company, give them a bit more information, and then hopefully, if they are suitable, take them on the path and help them raise capital. But just to manage expectations, we take on less than 10% of the companies that come to us. So equity crowdfunding isn't for all companies. They probably need to be established. They need to have certain structure in place. As we talked about earlier, they need to be companies, proprietary companies. Can't be a partnership, or it can't be a sole trader or ABN. And often we'll need to see some proof or some traction or something that we think is going to get the interest of investors. So it can't just be an idea. So companies need to kind of come with a well-formed strategy and plan and a pitch deck or some information that we can make an assessment. So we think it's suitable to potentially use equity crowdfunding to raise money.
Super interesting. So basically the range of, age of these companies, like it's from like a few months, I guess, depending for the one that are performing super well, to like a few years, I guess. Yeah,
typically the companies that come to us have probably been around for a year or two in the earlier stage. And then earlier in the year, we raised money for a company, Zyke, who are an Australian sailing apparel brand, who have been around for more than 10 years. They're doing sort of almost $20 million in revenue. They've got Matt Belcher, an ex-Olympian, one of our most successful Olympic sailors of all time, is the CEO. The company's quite established, and it's a much different proposition to an earlier stage technology or fintech business.
Okay, so if I become an Olympian, I would have more chances to register Upworth to an Equitise.
So look, some of the things we look at and investors look at around founders, some grit, determination, focus, passion, and being a subject matter expert, which all Olympians need, is a very good proxy and indicator of success as a founder. So, yeah, look, we would probably put you to the top of the list. If
I have to head back to go to the gym as up then. Cool. No, thanks for that. So if you don't mind, so what's the flow, right? Once you have invested in, let's say, one of the companies on Equitise, then you can actually add your private investment to, when we launch our product on Upworth, right? You will be able to list obviously all of your sources of wealth, whether it's, as I mentioned, bank accounts, crypto, properties, and also private investment. So you can connect and see everything from one place in Upworth. And if you don't mind, a few maybe questions that are a little more specific to you and coming from the kind of personal finance perspective, can you share a little more with us? And so this is an exercise we do like with all of our speakers. Can you share about your portfolio split more or less as of today between different asset classes, if you don't mind?
Sure. So outside of my superannuation and my property, my 2-bedroom apartment in Coogee that I have a mortgage over and the bank owns. All of my investments, other than a few very small holdings with some listed companies that are kind of what I would describe as bottom of the drawer, long term, might turn into something, a couple sort of mining exploration businesses. All of my investments are in Equitise companies. And indeed, a lot of my personal wealth and the last 10 years of my time and energy is tied up in my equity in Equitise. So I've lost track of the number of companies, but I definitely do believe in what we talk about, that the diversification and investing in all of the companies, or as many of them as you can, is the best way of potentially generating a return. So like, for instance,
you have more investment in like private companies from Equitise than in the public market?
Without a doubt, I have something like 40 or 50 companies I've invested into Equitise.
Super inspiring, actually. Skin in the game, as they call it. So that's like, a great example. Really interesting. And wow, okay. So playing for the long-term game. And
And the other thing, as I said, look, I have superannuation and I'm going to probably live and work in Australia for the next 10, 20, 30 years, even longer maybe. So in my mind, again, this is not advice, that is the nest egg, and that's what I will have that will hopefully be there for when I retire, and that will grow and accumulate. And again, depending on how that performs and what I'm earning, and if I sort of put more money into it, that is the money that I'll have long term. I don't have a self-managed super fund at the moment because I don't think I have quite a large enough balance to justify it. But outside of that, the rest of my investments and my lifestyle and what I'm, looking for, happy to do, is go for some more of that long-term, higher risk, potential higher return, investing in the sorts of companies that we help raise capital for.
And at the end, right, if you believe in your team and your process of evaluation, I guess that's you have already some of the work done in terms of evaluating of the potential of these companies.
Sure. So I haven't really tried to pick winners within those 40 or 50 companies. I've been investing less and less as time has gone on because I'm a poor entrepreneur. But look, again, that portfolio approach and diversifying and having companies at different size, stage, sector, is how I think we'll get the returns.
Super cool. So actually a question. It's a tricky one, but not really, but anyway. It's like, are you planning to ever do a crowdfunding raise for Equitise?
So we have kind of a couple times already raised from our wholesale and sophisticated investor audience. It's a little bit of a different proposition, and we had done those raises before the equity crowdfunding regulations were in place. For us to do our own raise, there's probably a little bit of additional compliance and things that we would put in place, and governance and stuff to make that available and suitable. We haven't done it. We might do it in the future, not ruling it out, but there's no imminent plans. As I said, for us to do our own retail equity crowdfunding offer, there's sort of a lot of additional kind of hoops and things we'd want to jump through and make sure are in place.
You probably like appoint like a third party to
things like that, to give investors confidence and also sort of mitigate the risk of us signing off on our own homework kind of thing.
yeah, yeah. Losing money from the fact that your own raise is not.
We probably wouldn't charge ourselves a commission, though.
Fair enough. Fair enough. You deserved it. Cool. And so basically, yeah, you were saying most of these private investments, so it's the long term. So you don't have any, like names in mind of like returns already made or things that you want to share on that, or?
Yeah, look, there's been a few come through. We also help companies as a part of IPOs. So we will occasionally help a company that's doing an IPO and might take a small allocation as part of that and act like a junior broker and have those companies. So I've invested in a few of those, and when they've listed, made some money. A couple have listed and then been acquired or had things like that happen. Some have yet to list, but probably going to maybe be acquired or list in the sort of more short term. There's one sort of advertising tech business that I'd invested in, and it's doing a big round at the moment, which is more than 10 times the original investment. Probably won't get a chance to sell into that round, but maybe that might happen. Sometimes that happens as companies get more established and they raise money. Some larger investors might come in and look to maybe mop up or offer to buy the shares of smaller investors. So might have some of those coming through. But there's been a few. Nothing sort of where I can say I made 100 times my money in a short period of time.
Yeah, makes sense. No, actually, so before we go towards closing quite soon this episode, I just want to give you like an opportunity. Like, are there any things that you want to share before we close on crowdfunding, the crowdfunding equity crowdfunding space in Australia or on Equitise, that any wrong ideas that people might have in their head about this space. Like anything you want to share?
Yeah, look, I mean, we obviously are passionate about the space, and we think it's an excellent opportunity for everyday investors. And also we have your traditional kind of wholesale and sophisticated investors, so venture capital, private equity funds, wealthy individuals, high net worth investing in our deals alongside our everyday investors. So that can be a big opportunity and benefit for people to invest alongside or invest, and obviously you're a smaller, more passive investor. But we, again, as I said, are trying to open up the market and make it more accessible so people can participate and hold investments in this as an asset class. One of the sort of things we often get is some misapprehensions or misunderstanding as to how it exactly works. That can often even come from companies. Companies might think that if they do it, they have to become listed, or there's certain requirements and other things that happen once they raise money. Often people have some misunderstanding or misapprehensions around that. So again, we encourage people to come and speak to us. We do provide some information on the website, but we're limited in sort of how much information and advice we can provide. But both for companies trying to understand it and investors trying to work out what it is and how they can invest, we're all about trying to educate and provide information and make it accessible for everyone. People can just sign up and create an account, and they don't need to invest. They can look at the deals as they come through. They can read the information, download the offer document, and then look at maybe weighing in and making a small investment to start, and then building up over time and those sorts of things. So it's very easy, very accessible. We think it's, again, as early stage capital markets are evolving, we think it's an important part of the ecosystem. We love supporting all these companies that often doing something amazing to try and change the world. So, we're there and we, want people to try and understand and participate and do things and invest in the companies we're helping raise money for.
Super cool. Thanks for that. So maybe a last question, and we to transition to Upworth. So you've seen a little what we try to build. Our product is coming soon, and so what do you think? What do you think about it?
Yeah, look, it's fantastic. With greater access to data and information, you can make more informed decisions. I think obviously our generation and the way kind of the financial advice landscape has evolved, it is quite difficult for people to necessarily understand their position, and people don't always want to go speak to a financial advisor, and often these days it's quite expensive and prohibitive, so people don't look to do that. Again, starting out in sort of the mortgage space, as you guys are doing, often, and particularly in Australia, most people in their 20s, 30s, 40s want to own a home, and that can be their biggest source and opportunity for wealth. And a very important foundation in building wealth. So to have access to information, to have access to products that can help you navigate that, I think that's tremendous. Again, the more informed, the easier it is you are able to make decisions, and I think that's fantastic. So really keen to see where you guys take it. We'll happily plug in and look at my portfolio and my assets in the app or online. But it's a great opportunity, and I think, again, as access to data and the security around accessing your personal information across different financial institutions or where you might have, and particularly looking at it with regard to different assets and even your superannuation and what that looks like, and other investments or other things, and your balance sheet, your assets and liabilities that you're holding. I think it's a fantastic tool and way to help people really try and understand and engage more with their personal financial situation to set themselves up for a future.
Yeah, definitely, we'll let you know when it's ready. And I mean, it's obviously, as you mentioned, right, like security and respect for privacy is essential. What's great is that in Australia as well, the regulatory standards around these subjects are very strict for it's for the interest of all of us, right? So yeah, we are building a product that's solid and compliant with all these regulations around open banking, as you mentioned, like consumer data rights, right? And in the same time being able to really, as you mentioned, like see everything in one place, and from there, from information and understanding of how it works. So obviously, as mentioned, like we are not providing financial advice, but we do give the picture, right? The big picture, the overall picture of all the details of the assets, abilities, or personal wealth of people when they will get on the product. And obviously, we are from this wealth aggregator side. We're also adding basically a one-stop shop for financial product, and as you mentioned, we will be starting with mortgage and home loan. So as a certified mortgage broker / authorized credit representatives, we'll be able to advise indeed people on this side, on the home loan, car loan, personal side of their balance sheet. But that said, really excited as well. First and foremost, excited about this great talk. Thanks again for joining us, Jonny. Super insightful chat, and thanks for all our listeners as well. So really for your attention. Don't forget to follow our podcast on Spotify. More episodes are coming on this exciting world of wealth management and personal finance. As a reminder, if you want to learn more about crowdfunding, don't hesitate to visit Equitise.com. As well, if you want to register on our waitlist to get the updates about our product coming soon, don't hesitate to go on www.upworth.com.au and become the master of your fate, the captain of your soul. Thanks a lot, everyone.